You're probably sick of hearing just buy great companies when no one tells you where to find these great companies. As a value investor, I can set up a stock screener and have a list of 50 companies that meet my value criteria, but nothing's jumping out at me. I don't know which ones are the great companies with huge growth potential because I'm not an expert on all of these companies. Without a reliable system, I'm going to continue to miss the rare opportunities that deliver the real returns. That's why in this video, I'm showing you how I mine high growth potential companies from the portfolios of famous investors. To name one, we're looking at Cathie Woods, who has popularized the style of investing in highly disruptive companies, and she has done this with great success. Cathie Woods has several different portfolios with different themes. In this video, I'm looking at ARKG, which is right here. I have pulled up the Genomic Revolution ETF. It's got 34 different holdings. So I'm going to be combing through all of these. This portfolio is cool because it is focusing on genomic sequencing, how it is changing the way biological information is collected, processed, and applied. ARKG is focused on the disruptive innovations that are increasing precision, restructuring healthcare, agriculture, pharmaceuticals, and enhancing the quality of life. Now, the difficult part of starting with a group of companies that are highly disruptive and have high growth is that almost none of them are profitable. As I'm scrolling through this list, almost every single one of these companies has no profit, negative operating income, negative operating cash flow, and tons of debt. So I had to get to the very bottom of the list before I found one that started to meet some of my criteria. I'm talking about Regeneron Pharmaceuticals. My first step was to quickly look at all of these companies on stockanalysis.com and just see if they had positive operating income. And then if they did, I would hop over to the ratios tab to see if they had a decent price to free cash flow ratio. Free cash flow is my number one metric that I like to look at. I prioritize it over the price to earnings ratio because free cash flow is the chunk of money that a company is able to return to shareholders. It's what they use to actually pay off their debt, pay a dividend, do share buybacks, or grow the company. So I like to focus on free cash flow. This company has both operating income and a good ratio. So I took it to the next step, which is using my automated spreadsheet. I type in their ticker right here. You go to my Buffett supplement tab where I automatically calculate the red flags that Warren Buffett uses when he is deciding whether or not to invest in a company. If a cell is highlighted green, it's a green flag. It means that this company has a high likelihood of having a durable competitive advantage. If a cell is highlighted red, which I'm not seeing any, then that is a red flag, which requires a little bit more research. Now, in this case, there is one red flag that jumped out at me. R&D is 0%. This is the percentage of their gross income that they spend on R&D. For a pharmaceutical company, this is impossible. They cannot possibly spend zero on R&D. There has to be a mistake here. So whenever I go to their income tab, I see that they do not break out research and development. Surely they have to have some. So I had to go to their most recent annual report to see how much they actually spent in 2024 on R&D. And then I had to do that math by hand. Here's the page from their annual report, research and development in 2024, $5 billion. I need to compare that to their gross profit, which is $7 billion. So that's over 50%. That would be one red flag. So right here, my criteria is anything over 30% of gross income is considered a red flag to Warren Buffett. He does not typically like to invest in companies that are forced to spend a lot on R&D because it is just a constant expense. He prefers companies like Coca-Cola. Once they have their recipe figured out, it's patented, it's secret. They don't have to spend very much on R&D to continue to make money. So this would be the one red flag. And if I'm looking at companies that are trying to benefit from the genomic revolution, this is going to have to come with it. There's going to be some R&D expense if I'm going to invest in this basket of companies. So I am willing to look past the R&D red flag because everything else looks really strong. They've got strong profit margin, 31% in 2024, averaging over 30% profit margin, very little interest. Their interest expense as a percentage of their operating income is incredibly low. They also have very low debt. This is their long-term debt divided by their profit. If they wanted to, they could take their profit, half of their profit from 1 year and pay off their entire long-term debt. So this company has low debt. They're very profitable. And on top of that, whenever I go back to their balance sheet, I can see they have tons of cash on hand. In 2024, they had $9 billion. Currently, they have $8.3 billion. So they've got a huge cash position. They're very profitable. They have no debt. This company is looking like it's very financially strong, and it has a high likelihood of being a growth company. So what is the reason here for it being priced low? Once I go to the overview, I can see that something happened in August of 2024. They had peaked at almost $1,200 per share, and they have since lost over half of their market cap. So something has happened. This is the next step. What went wrong in the last few months or over the last year? And does it result in this company being underpriced? Are they oversold right now, or are they priced low for a reason? I've got to be able to answer this question. This is where ChatGPT comes into play. ChatGPT is perfect for research. I love this new tool that's come out recently, the deep research tool. ChatGPT, in this case, searched for 7 minutes, found 21 sources, did 91 internet searches to answer my question, why did Regeneron sell off in August of 2024? ChatGPT is so good at this kind of research because it can read a million times faster than me. It can compile all of the sources for me to check if I want to. This is the ideal way that I like to use ChatGPT to help me with my investing. So on August 1st, Q2 results, they had strong overall earnings, but they revealed that one of their major 4 pharmaceuticals was falling off. The US, I don't know if I'm saying this right, EYLEA revenue had dropped by a significant margin. When I look at Regeneron's latest quarterly report, I can see the EYLEA revenue has dropped off by 29%. And this is one of their larger sources of revenue. In 2024, this quarter, last year, they got $2 billion in revenue. This quarter, they only got $1.4 billion. So that is a significant sell-off. They are releasing a new version of the EYLEA, the high dose version, and it is increasing by quite a bit. In 2024 to 2025, it increased by 111%. So that gain is offsetting the losses to some extent, but not nearly enough. The next catalyst is competitive signals. ROCHE announced surging sales of Vabysmo. I don't know how to say a lot of these, and raised its outlook, underscoring that Regeneron's EYLEA was losing market share. Their competitors are doing well. They are flat on their revenues. And then there are biosimilar approvals with the FDA. This is the third thing. So the FDA approved multiple EYLEA biosimilars during that month. So they've got more competition. Their revenue is flat. So there is signals that they are losing market share. And then the investor market reaction as August progressed, analysts and investors grew increasingly bearish. The confluence of the above events triggered a significant sell-off. So it looks like the stock has sold off for good reason, but my suspicion is that the market has oversold this company. So my next step is to look at the free cash flow valuation to see what kind of future free cash flow would justify their current share price. To calculate the future free cash flow valuation, I first need to know what kind of future free cash flow are we looking at. I like to go to stockanalysis.com and look at the analyst forecast to see what kind of future revenue are we expecting. When I scroll down here to the revenue growth forecast, there is a pretty wide range of analyst expectations here. So I'm going to copy this information, put it into my automated spreadsheet right here. This is where I plug in the revenue growth. The second thing that I need to take into account is the free cash flow margin. What percentage of revenue does this company historically turn into free cash flow? Over the past 5 years, they have achieved an average free cash flow margin of 31%. However, when I go to their financials page, I go to their cash flow, I can see that they are able to raise this figure quite a bit because they have a large stock-based compensation. So they're paying their employees in stock instead of cash. So that cash, even though it's a loss on paper, that cash gets added back in to their free cash flow. And then if we scroll down a little bit further, I can see that they are turning back around and they're spending that cash to repurchase common stock. So they are still using that cash. I like to count that against their free cash flow. So I have to do one change to this free cash flow calculation. I do that right here. So the new average is 26.5. That is why I put -4 in the free cash flow adjusting cell right here. So I'm actually using a free cash flow of about 27%. With that in mind, this is the potential range of share prices that I would expect using the discounted future free cash flow analysis. Now, this is using the analyst projections for future revenue and the updated past free cash flow margin. So if the lowest analysts are correct, which this graph is showing the range of analyst revenue projections, the green being the lowest analyst projection. So they're showing a huge drop off in revenue. If the lowest analyst is correct, then we're looking at a 25% downside. If the average analyst is correct, basically showing a small drop off in 2025 and then moderate growth going forward, then we're looking at a 37% upside. If the highest analysts are correct, we're looking at 124% upside. The past projection uses the past revenue growth. Over the last 5 years, this company has had a 10% revenue growth. If they're able to continue with that trend, then we're looking at a 74% upside. And then finally, my projection, if they're able to increase their revenue by just 3% over the next 5 years, by 3% in years 6 through 10, and then 3% going forward, then we have a 27% upside. So I'm seeing really strong upside potential. The next step is I need to be confident that the lowest analyst is not going to be correct. What kind of evidence can I find that would hint at REGN's future revenue situation? Does it look like they're going to be increasing their revenue, or are they having tough times ahead? To answer that question, I'm going to be looking at their latest quarterly earnings report and their most recent annual earnings report. So in their investor presentation, they point out they have 4 blockbuster products. We've already seen that EYLEA is on the drop and EYLEA HD is on the rise. So do we expect this trend to result in more revenue or less? When I look at the past 3 years of these different products, I can see that EYLEA HD in 2022, it wasn't a product. 2023, 165 million. 2024, 1.2 billion. So it has had a massive increase. But when I compare that to EYLEA, we see it's been dropping off by 500 million in 2023 and then about a billion in 2024. So the result is the total revenue is lower from 2022, but it has actually gone up since 2023. According to the past trajectory, it looks like the EYLEA HD is making up to some extent. It looks like it's making up for EYLEA. This looks concerning, but it's not the end of the world, because if I go back to their earnings presentation, they have an unprecedented research and discovery capability. They've got 45 products in the pipeline. So this is referencing their R&D investment. Another thing I like to look at is how much R&D are they actually spending? Is it going up every year, or is it staying flat? If I scroll down a bit, I can see the past 3 years of research and development, and it is constantly on the rise. $850 million increase from 2022 to 2023, and then $700 million increase from 2023 to 2024. To me, this shows confidence in their products, confidence in their research and development, and their pipeline of future drugs. The next thing I like to look at is the capital expenditures. For this, I'm going to go back to the financials page on the cash flow statement. I can scroll down a bit where they show the capital expenditures. Since 2021, they have been increasing their capital expenditures every year, and it has gone up even recently over the trailing 12 months. So capital expenditures continues to go up, research and development continues to go up. These are signs of confidence in my eyes. To check out another one of their 4 blockbuster drugs, we see the trend on Dupixent. I hope I'm saying that right. So since Q1 of 2024, we see a 20% increase in that blockbuster drug. If I look at the summary from the past 4 years on the annual report, the final one is Libtayo. Once again, if I go back to the annual report, I can see that the total Libtayo global revenue has been increasing by 415 million from 2022 to 2023, and then 350 million from 2023 to 2024. It's almost tripled in sales. So it seems like their other drugs are increasing quite a bit to offset the loss in the previous EYLEA drug, which the new high dose version is performing quite well. Finally, at the bottom of their presentation, the capital allocations that they're prioritizing to drive long-term growth are internal investment. Once again, talking about the high R&D going into 2025, They continue to have share buybacks. These have increased over the last few years, over $1 billion in share repurchases in Q1 of 2025. That signals that this company believes that their current valuation is too low and they are buying back shares at this price. They've got an additional $3 billion authorized in February of 2025. So they're continuing to put their money where their mouth is. So what kind of revenue growth does the current share price justify? If I assume over the next 5 years that they lose 3% of their revenue on average every year, my projection gives me $508 per share, which their current share price is sitting at $509, $511. So that is what the market's telling me. The market believes that this company is going to lose 3% revenue over the next 5 years, even though the past few years or the past 5 years, the average revenue increase has been almost 11%. And then they're going to stabilize and start increasing their revenue with inflation going forward. In my mind, the lowest analyst projection of a 25% downside more than justifies the average analyst projection of 37%. Because this company continues to put their money where their mouth is, increasing their R&D, increasing their capital expenditures, and increasing their share buyback program, I think the risk reward is worth it for this company. It's highly disruptive, it has high growth potential, and it's currently sitting at a decent valuation because, in my opinion, the market has overreacted to one of their blockbuster drugs dropping down in revenue. Now, there are some legitimate reasons. There's more competition, but they've got another replacement drug out there, the high dose version, that's performing really well. Once again, if I go to the overview, if I look at the 5-year chart, the market has put this company back down below where it was 5 years ago in 2021. This week, I will be investing in REGN as a part of my public YouTube portfolio. Pull it up right here. I've currently got 22 companies that I've invested in. REGN will be the 23rd company. I invest in a different company every week. I'm focusing on value because not only does it give me greater upside potential, it also protects my downside just in case we go into a market recession. I've got my companies sorted by most returns to least returns. And one that really jumps out at me is actually British and American Tobacco, BTI. It's my second best returning stock, and it's a high dividend stock. It currently has a 6% dividend. A lot of investors are actually really torn on whether or not dividends are a good thing or not. People point to the tax implications. Other people point to the stability. If you want to see my take on whether dividends are worth it, check out this video right here. I hope to see you there.